Tom Lee and Fundstrat are out with a few new notes today on why stocks will continue higher over the next couple of weeks. Specifically, IWM, the Russell 2000 ETF that continues to outperform. Even the equal weight S&P is hitting a new all-time high today. And the Russell 2000, which continues higher as well, hitting levels you have not seen since late 2021. The Russell 2000 is up almost 2% yet again today. Fundstrat says broader market could play catch up to technology as IWM breaks out. The weekly chart of IWM shows the absolute breakout in IWM above 210. That arguably should kick off a rally in the weeks to come. And this is the chart that Fundstrat's Mark Newton provides, and he's looking at a weekly candlestick chart, which is probably appropriate to do in this specific circumstance. And judging off of this chart, that would make sense why IWM and small caps could continue to rally. Because again, let's be honest, we're heading into the first Fed rate cut that's priced into markets for September, whether that's November, September, December, doesn't matter, because the economy's doing okay. That's the argument. And if we're heading into a rate cutting regime from the Fed and the economy is doing well, what's there not to like about small caps? And you can see here the expected EPS growth of small caps is around 18.5% for this quarter, 62.5% for next quarter, and then 89.1% for the fourth quarter of 2024. And it doesn't stop there, because first quarter of 2025, you're expecting 46.9% growth, and then 53.2% growth in Q2, 33.6% growth in Q3, 27.3% growth in Q4, and 2026 for Q1, you're expecting 28% growth. And when you're looking at year-over-year numbers here, comparing Q3 2024, which is expected to grow 62.5%, to Q3 of 2025, expected to grow 33.6%, that's still very strong year-over-year growth. Not necessarily starting from a low place like we are now, but just starting from a place that's higher and going even higher. Hopefully that makes some sense. I also think it's worth remembering that while the Russell and the equal weight S&P did not participate basically at all for much of 2024 so far, I think that means you could see these areas of the markets hold up better if we do go into a potential correction. I think what a lot of Wall Street fund managers are going to fail to tell you over the next couple of weeks is the back half of July is seasonally one of the worst periods for markets. And given how much your mega cap tech has rallied in just the last quarter, anywhere from 25% on the low side, like that's the low side, and then 60% on the high side, you're probably due for a reset of expectations. And given the Super 6 or Mag 7, whatever you want to, terminology you want to use, that controls about 40% of the markets. So a disappointment there would not be great for the headline S&P. But I don't think it needs to spell disaster for small caps or for even the equal weight S&P. And I think at this point you should be prepared for a correction, and I would use it as a buy the dip opportunity as long as the economy continues to hold up, in which it looks like it is. And while history does not always repeat itself, it usually does rhyme. And this rhyme could be good for your portfolio. Ryan Dietrich points out on X, needs some good news. The Russell 2000 small caps outperformed the Russell 1000 large caps by 3% on July 11th, 2024. Other times this has happened was 1987 low, October 08 low, October 2011 low, the March 20th low, January 21st, November 23rd, and last week. All of these were super bullish times. In fact, the S&P 500 was higher a year later every time and up on average 32%. Fundstrat and Tom Lee say 5 reasons June CPI gave a green light for small caps to continue to rally. Failed assassinations attempts against Trump is positive for Bitcoin and cyclicals. The astonishingly low June CPI, in our view, is giving the green light for small caps to continue to rally. Moody's says today the Federal Reserve could begin policy easing with a 25 basis point cut as early as in the upcoming 30th to 31st July meeting. Moody's says today the Federal Reserve could begin policy easing with a 25 basis point cut as early as in the upcoming 30th to 31st July meeting. Although that does look likely, it's still a possibility. Markets are only pricing in an 8.3% chance that we will get a July 31st cut. And as to what I said earlier, the second half of July tends to be a pretty rough period relative to the first half of July here in yellow, where you tend to go pretty much straight up. It usually peaks around July 17th, and then you do start to see a downtrend. And that does perfectly coincide with Wednesday's earnings reports from ASML. That will be very important for your AI trade. And again, let's be honest, you need to be impressed, like knock your socks off impressed, or there could be trouble in paradise. You're also going to get Johnson & Johnson, Allegiance Health, Ally, Synchrony, US Bank Corp, and many other banks that report pre-market Wednesday. Wednesday and after hours, you get United, Alcoa, Discover, Kinder Morgan, Crown Castle, Steel Dynamics, and many more. And then Thursday is going to be really your biggest day with TSMC pre-market and Netflix Thursday and after hours. The markets are now pricing a September rate cut as a 94% probability. I think the bigger question becomes, do we get a 25 or 50 basis point cut September? And that really depends what happens with the economy. Goldman Sachs also is coming out today and says the Fed has solid rationale for a July rate cut. And another potential risk to markets, not trying to get political here, but according to Politico, former Speaker Nancy Pelosi is convinced Biden will lose, has been working the phones since June 27th in hopes of finding a way to ease him off the ticket. If Biden were to abruptly step down in some fashion and see someone else step up, that would create more uncertainty around the election, and that would be seen as bad news for equities. But that is only a hypothetical, and we won't know anything until it happens. Dan Ives, one of the best tech analysts on Wall Street, and he does work with Wedbush, he says, we believe Q2 earnings will be a major positive catalyst for the tech sector and expect tech stocks to be up another 15% for the year, adding to a robust tech gains in the first half of 2024 as the AI revolution spending wave takes center stage and propels big tech higher during earnings season. Although that's certainly possible, expectations are higher than they've been in a very long time for the tech sector. So could it go higher? Of course, but you would need to see a knock your socks off kind of earnings report. Fed Goolsbee reports today that interest rate cuts are soon warranted. You are starting to see some yield curve uninversions today. And this has really been taking place over the last couple of days. Kevin Gordon on X is reporting that the 30-year Treasury yield is now above the 2-year Treasury yield for the first time since January. The one people pay the most attention to, I would say, is the 10 and 2-year yield curve inversion. That's been inverted for over 2 years now, the longest inversion in history, and you're still inverted 27 basis points, even though at one point you were inverted over 1%. It's actually the uninversion that is painful typically for equities, and that's usually happens because the Fed is about to cut rates, and that usually coincides with a recession. So that's the historical precedent. If you hear people say, oh, the yield curve is uninverting, that's because the Fed's about to cut rates, so that's getting priced into bonds. And usually, historically speaking, when the Fed cuts rates, recessions come shortly after. So normally that uninversion, pretty painful, and then shortly thereafter, within about 3 months, historically, you tend to enter recessions. But that doesn't necessarily need to happen. Another yield curve inversion that a lot of people like to pay attention to is the 3-month 10-year yield curve inversion, and this sucker was inverted at the low almost 2%. It's still inverted about 1.25%. So not really anything to worry about here. But this is more so triggered when the Fed is about to rapidly cut interest rates by a large margin. Seth Golden writes on X, it's hard to make the case for a recession when crude oil is so well contained and fails to make lower lows. The wedge pattern suggests steady as she goes economic conditions. But as Gunjan Banjiri reports on X, implied correlation for the S&P 500, stocks are hovering around a record low. Moody's says today we expect the Fed funds rate to be reduced by a cumulative 50 to 75 basis points in 2024 and another 100 to 125 basis points through 2025. And it's also being reported that Tom Lee reiterates his call for IWM gaining as much as 50% in 2024. So far, we're just up 6%. I think what's actually one of the most interesting things about today is while you have the Russell up over 1.5%, the NASDAQ up 1/3 of 1%, S&P close behind, the Dow that is up almost 0.5%, you also have the VIX that is up 6% today. That's a large move higher on a green day. Typically, the VIX moves higher, I shouldn't say typically, always the VIX moves higher when there's more puts being bought on any given day for the S&P than calls. So you are seeing a decisive flip from calls being bought as a majority on the S&P today, now to puts being bought on the S&P, which is something we have not seen in a long time. And again, I have to imagine some of that is because of earnings that we are going to get throughout this week. We also get retail sales data that comes out tomorrow. You're expecting 0%, but some economists think this could come in really negative and it will affect your GDP estimates. You also get export prices and import prices, which do have a large impact on GDP. Currently, the Atlanta Fed GDP Now tracker is sitting at about 2% expected GDP, but that could go up a lot or down a lot coming tomorrow, and that definitely can affect markets. Judging off of this move higher in the VIX today, someone is nervous. I will also mention for the bulls, if you look at this trend line, it would suggest that there can be quite a bit of upside left here in our markets if earnings do go well. Just to get to this trend line from here would be another almost 4.5%. The percent of stocks trading above their 50-day moving average is up to almost 66% today. And you do have about 2.5% of all stocks breaking above their 50-day moving average. So you have went from 35% of stocks trading above their 50-day moving average to 66% of stocks trading above their 50-day moving average in just the last week and a half. That's a pretty strong sign for equities. Now, as a contrarian, perhaps you could say, well, now if you have participation, does that mean we can finally get the downside because you're starting to get some capitulation, some short covering? And that's also kind of a valid argument. The latest AI investor sentiment survey that we have shows bullish investors at 49.2%, neutral investors at 29.1%, and bearish investors at 21.7%. And last but not least, the fear and greed indicator today is at 61, which is now firmly in greed territory. On Friday, you were at 56, and this is rising because of the participation that you are starting to see in markets. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a fantastic rest of your day, and I will see you in the next one.